Today we are going to talk about stablecoins. Of course, they have been getting more and more popular in recent times. But why? Why do they really matter? Well, that is what we will be finding out today because stablecoins are nothing new. You know, they have been around for a long time. And if you look at the graph, you can see that the market cap has been increasing exponentially year after year. Now, one of the reasons behind this trend could be that more and more companies start accepting them as a form of payment. But there must be another reason. Let's find out what it is. So before we get into the details, let's quickly define what a stablecoin actually is. So basically, it is a type of cryptocurrency that is pegged to a reserve asset. And here you should know that this reserve asset could be anything from a fiat currency, such as the US dollar or even gold. And the main idea here is to reduce volatility, because we all know that cryptocurrencies are known for their price volatility, which makes them less than ideal for everyday transactions. However, stablecoins aim to solve this problem by providing a coin that is backed by a reserve asset, whose value does not fluctuate much, which makes them much more suitable for daily use. Now, one thing that you might wonder is, how does a stablecoin actually work? Well, there are two ways in which they can be created. The first way is through fiat-backed stablecoins, and an example of this would be USDT. Now, with fiat-backed stablecoins, the issuer buys a reserve asset like the US dollar for each coin that is minted, and these coins are then sold to investors who believe that the coin will maintain its value relative to the reserve asset. For instance, if 1 USDT is backed by 1 US dollar, then theoretically, 1 USDT should always be worth 1 US dollar. The other way is cryptocurrency-backed stablecoins, and an example of this would be DAI. Now, with crypto-backed stablecoins, the issuer buys and holds a basket of cryptocurrencies as collateral to back the stablecoin. In this case, instead of being pegged to the US dollar, DAI is actually over-collateralized by crypto assets, and its value is maintained through an algorithm. However, there is another type of stablecoin known as hybrid stablecoins, which combine elements of both fiat and crypto backing. An example of this would be USDC. Now, this coin is backed by both US dollars and a pool of crypto assets, and its value is maintained through an algorithm just like DAI. And next, it is important to differentiate between centralized and decentralized stablecoins, because this is where things get interesting. Centralized stablecoins are issued and regulated by a central authority, which can be a company or an institution, and an example of this would be USDT. On the other hand, decentralized stablecoins are not issued or regulated by a central authority. Instead, they are created and maintained through a decentralized network of computers, and an example of this would be DAI. And while there are many different types of stablecoins, they all share some common features. First, they are designed to maintain a stable value. This means that they should not be subject to the same price volatility as other cryptocurrencies. Second, they are typically used for payments or trading other cryptocurrencies. And third, they are often used as a bridge between fiat currency and cryptocurrencies. Now that we know the basics, let's talk about why stablecoins really matter. First, they make it easier to move money around the world. Stablecoins offer a fast, cheap, and secure way to move money around the world without having to go through traditional financial institutions. This is especially appealing to people who live in countries with unstable currencies or who want to avoid high transaction fees. Second, they make it possible to trade cryptocurrencies without worrying about price volatility. When you trade cryptocurrencies, you are always exposed to some risk due to price volatility. However, when you use stablecoins, you can trade cryptocurrencies without having to worry about this risk as much. Third, they can be used to build decentralized applications. Stablecoins are often used as a building block for decentralized applications because they provide a stable and reliable way to store and exchange value. Now, the most popular stablecoins are USDT, USDC, and BUSD, but there are also some newer stablecoins that are worth mentioning. First, we have USDT or Tether. This is a token on the Ethereum network, and it was created by the Tether company in 2015. Each USDT represents $1, and the tokens are traded on several exchanges. Then we have USDC, which is a token on the Ethereum network, and it was created by Coinbase in 2018. Just like USDT, each USDC also represents $1 and is traded on several exchanges. And finally, we have DAI, which is a decentralized stablecoin that was created in 2017. Unlike Tether and USDC, DAI is not pegged to the US dollar one-to-one, but its value is maintained through an algorithm. And it is important to mention that there are also some stablecoins that are pegged to assets other than the US dollar, such as the euro or even gold. However, these stablecoins are not as popular as those pegged to the US dollar. But wait, everything sounds so great. So are there any downsides? Well, yes, there are a few things that you should keep in mind. First, stablecoins are not truly decentralized. Most stablecoins are issued and regulated by a central authority, which means that they are not truly decentralized like other cryptocurrencies. This raises concerns about censorship resistance and the possibility of collusion between the issuer and other market participants. Second, stablecoins are not immune to hacks or other attacks. While stablecoins are generally considered to be very secure, they are not immune to hacks or other attacks. For example, in 2016, the DAO, which is a decentralized organization that was experimenting with a stablecoin, was hacked and millions of dollars were stolen. And third, the value of stablecoins is not truly stable. Although stablecoins are designed to maintain a stable value, their value can still fluctuate. This is because the assets that they are pegged to can also fluctuate in value. For example, during the COVID-19 pandemic, the value of USDT and other stablecoins briefly dipped when the markets became stressed. Despite these downsides, stablecoins are still a relatively new innovation, and the technology is still developing. As the technology matures, it is possible that these downsides will be mitigated. And overall, stablecoins are a disruptive force in the finance industry because they challenge the traditional role of banks and other financial institutions as intermediaries in the movement of money. They also have the potential to bring financial services to people who do not have access to them, such as people in developing countries. In the future, we may see stablecoins become more widely adopted and used for a variety of purposes. There are also some exciting developments on the horizon, such as the launch of the Euro stablecoin by Circle and the launch of the GBP stablecoin by Crypto Finance. These stablecoins are designed to make it easier to move money within the European Union and the United Kingdom, respectively. They are also expected to make it easier to trade cryptocurrencies within these regions. In conclusion, stablecoins are a growing part of the crypto market, and they have the potential to disrupt the traditional finance industry. They offer a number of benefits over traditional currencies and financial instruments, and they are becoming more popular as time goes on. If you have not already done so, now is a good time to learn more about stablecoins and how they work. Who knows, maybe you will decide to invest in them or even use them for everyday transactions.